Welcome back. I'm Sal Bashemi, CEO of Dandrew Media and co-founder and managing director at Dandrew Partners here in New York City. In this 5-minute fundamentals mini-series, we're going to uncover and demystify the sacred principles of commercial real estate finance in a very easy to understand whiteboard series. What is this that you ask? It's something that most people talk about, but very few people actually know anything about. It's called capital structure. We're going to go over what a waterfall is in commercial real estate and all of the terms that larger institutions will demand you know and understand when dealing with them. This is the first of a 3-part mini-series where we discuss the senior loan, the debt. And this is my promise to you that after this mini-series, you'll know more than 90% of the sell-side professionals and borrowers out there. And that means undisputable credibility that will drive profits to you in this high-dollar business. So let's get started. Welcome, how are you? Welcome to the 5-minute fundamental series we've put together here. In 5 minutes over the next 3 series that we've put together here of videos, we're going to be talking about capital structure, cap stacks. This is things that I really like, and these are things that you need to learn about because, believe it or not, a lot of people who own real estate don't really know what capital structure is. It's up to us financiers and bankers and people who are doing the matchmaking to understand where the capital comes from. And when you're facing off with a lot of high net worth institutions such as family offices, pension funds, hedge funds, what you want to make sure that you're dealing with is that you're speaking the right language, because these people are going to put you to task and they're going to want to know exactly what it is you're talking about. Now, one thing I promise you when you finish watching this video is that you're probably going to know more than 90% of the other capital brokers out there. The reason is because they don't really have a similar background, but they're not really working on the same size deals either. So let's get started. This one here that we're starting with today, we're talking about debt. We're starting out with the basics. This is the foundation. So if you think about it right here, senior debt, first trust debt, these are the tools, the financial instruments that are used in commercial real estate. Senior debt comes in many different shapes and forms and sizes. In commercial real estate, a lot of these come from what we call portfolio lenders. These are usually, could be considered life companies. These are your MetLife, for example. When you pay life insurance premiums, these premiums are used to be invested into commercial real estate loans. So if you go into big cities and you see all these tall buildings, the mortgagees, or the people who hold the paper on that, are actually going to be life companies. And they do that up to millions to sometimes billions of dollars. And that debt is also sliced up into different tranches too, which is very interesting. Then we have the smaller local regional banks. The smaller local regional banks usually hold these for about 10 years. Right now we're coming up to a time where there's a huge wall of maturities that's getting ready to hit, where a lot of these loans that were originated about 8 years ago are now suddenly trying to get refinanced. So that's an opportunity for all of us here right now. The smaller regional banks is where you're going to find a lot of opportunities for people who, bankers rather, and people on the lending side are going to want to be able to refinance their borrowers out of these, performing or non-performing. And there's all sorts of reasons behind that, and that has to do with regulatory issues, concentration risk. Maybe they've lent too much money to the same person. Maybe they have too many loans in the same asset class like land or retail. Or maybe they just feel as though they want to divest of their holdings because they don't know if this borrower is going to be able to get taken out or not. So debt is very important. It's the foundation. A lot of these guys today will go up to about 65%. Opportunistic lenders. These are people like hard money funds, some private equity real estate funds, discretionary capital providers. These are guys that'll go up maybe a little higher on this too as well. These are short-term loans. These are short-term bridge loans. If you ever heard of the term bridge debt, they go between 3 years to maybe as far as 6 years, but it's just meant for the purpose of the borrower, or what we call in the commercial world, the sponsor, being able to acquire these assets quickly and then refinance them with more permanent financing, such as life company debt, life company loans, to have Snoopy come in and be the mortgagee on these loans. When you think of now commercial real estate and you think of Snoopy, you think of MetLife, and that's exactly where a lot of these premiums that you make each year are going into these huge, tall commercial buildings. So let's talk about the attributes here. When we talk about debt, we talk about a capped upside. Meaning, let's just put this into perspective of $1 million deal. Let's say you buy an apartment complex for $1 million and you sell it for $4 million. Do you share any of the windfall that you have with the bank? Absolutely not. So the bank is capped. They have a capped upside. So if you're only giving them 5% per month on an interest rate, well, that's all they're going to be getting. And that's very important to discern that. When we get into equity and mezzanine, We'll talk about how those structures are a little different. Also, they're secured. Okay, if you don't pay, what happens? We talk about the remedies. There's a foreclosure of collateral here. You have an enforceable lien. Your security is an enforceable lien. So if the person doesn't pay, Snoopy can foreclose on you by just filing a foreclosure on it. The collateral is an enforceable first lien. So that's why we have to make sure that when we're talking about debt, or when we're talking about any of what we call structured products here, which is what it is, it's financial structured products, that we talk about remedies, and that's the most important part here. And of course, the preference of repayment, that's important. Of course, you're going to pay your mortgagee first, you're going to pay the bank first, the lender, because if you don't pay them, guess what? They're going to foreclose. So they get paid first. And when we talk about this in subsequent modules, we're going to be talking about what a waterfall is. And a waterfall is basically the preference of repayments. So stay tuned, we're going to move on now to the next stage of this, and that's called mezzanine financing.